Russell Markham here from VectorVest, and my apologies. You can hear my voice is a bit croaky today. I don't want to hold up the live presentation today. I might have to keep it a bit short. But what I'm going to do here today is I'm going to show you some of the challenges that I set myself to making good money in the market with VectorVest. Now, before we get going today, please note our license numbers. There are license numbers. In addition, please note general advice only. I cannot take into account your personal financial circumstances. Please speak to a financial advisor for personal advice. All right, so let's just transition the camera here just for a second here. So I've set myself this goal. I've got a bit of money from some previous investments, sold a property as well. So I've got around about 207,000 Australian dollars sitting in my cash account. And I set myself the goal. I've been working VectorVest now for just on 15 years. And I want to basically look to double that money in the next 12 to 14 months. I've done it before in smaller sums of money using prudent risk and money management rules. And for this exercise, I want to basically do it in the US market. I love the Australian shares. I've got lots of Australian shares already, but I want to bulk up my US shares as well. All right, so that's the challenge I've set myself. It's got to be safe, reliable shares, no gambling type stocks. I'm not interested in high risk speculation, penny horror type stocks. None of that. It's got to be prudent risk and money management rules. And that's what I set myself the goal. Right, so without further ado, I'm going to jump into VectorVest. I'm going to close that here. And I'm going to cut straight to the chase for us today. All right, so let's just make this look a little bit bigger. Spent a good couple of hours yesterday just, tweaking my shares. It's early days yet. All right, I'm going to perfect what I'm going to find first. So let's just keep this nice and easy to begin with. Don't worry about all this for now. Okay, I'll just pull this out here. So these are the given companies here. All right, in America, ticker code DRS, FNMAS, Dash, and DB. Deutsche Bank, DoorDash, Fannie Mae, Leonardo, DRS. Well, why have I picked these ones here to begin with? Now, let's just have a look at what the average looks like across these stocks. I'm not interested in anything at this stage, just in the early building blocks here. What does it look like? So if this is going to be a group of stocks to begin with, now I'm going to need a few more than just simply 3 or 4. All right, so it's early days yet, and I've called the portfolio here 207K because I want this to basically, I want to be able to double it. So that's the starting monetary value, but this is average all the stocks. And so I asked myself over 2 years, 8 months, do I expect this to keep running up? Yeah, a bit of a pullback here. I don't like that pullback there, but there was a big pullback in April, with all the talk about tariffs and the likes. The market panicked, and then the market sort of picked itself up and it rocketed off again, at least across these given stocks. So to set myself the challenge, where do I go and find these stocks, and how am I going to make this all work out? And so these are the initial building blocks from which I begin. Right, I'm not saying that these are the right ones just yet, but these are the initial building blocks. And so why do I like, these type of shares? It doesn't necessarily mean all of them are great, but collectively they come together. This one's got a bit of a weakness here, but then it's got strength over here, etc., etc. So collectively combined, doesn't look too bad, but we can certainly improve it further. So it's early days yet. This is the early building blocks. All right, so drilling into the individual shares, these are the key things I'm looking for when building it with VectorVest. All right, so first up, the trend has got to be moving upward in the right direction. If it's not, you're not making money. I certainly don't want this thing to be falling down like it was here. That wasn't good enough. It's got to be going up, and when it goes up, that's when you make money. That's the whole reason why we buy these in the first place, these given shares. So I look at this and go, okay, well, don't really like that. That wasn't good enough there. But having said that, a lot of shares rolled over in that April time period of 2025, and the good ones continue to power on. All right, well, it's okay. It's okay. It's a good start. What else we got? The key driver here is earnings, EPS. This is a 12-month leading forecast on earnings. So if you're not buying into companies that are growing their earnings year in and year out, then you've got you don't have a very good chance of making money. And sadly, a lot of investors just have never really been taught this. They haven't been taught that, you need to buy into companies that are growing their earnings. And so if you're buying into companies that are consistently growing their earnings, this is a 12-month leading forecast on earnings. So it takes into account historic, current, and then forecasted earnings. And so you can see over here, as the earnings keep moving up, it helps drive that share price higher. Okay, so we've got to buy into companies that are growing their earnings. So this one, tick, all right, good. This is the earnings growth rate. What is the company looking to grow its earnings by? And again, we've got to make sure that that is beating inflation and interest rates. So if inflation is at 2 to 3%, and interest rates are around about 5 to 6%, then inflation plus interest rates, what's that? About 7 to 8%. This company is looking to grow its earnings by 18%. So it's going to outperform both inflation and interest rates, and therefore this bodes well for the earnings. One of the other things I also like to look at too is this company making money. Net profit margin. So if let's change the style on this one here, and just make it jump out a bit more. Here we go. All right. So net profit margin was sort of cruising along, and then it dipped, fell down. But having said that, it's still very solid at around about 8.91. So just shy of 9 cents in the dollar. Just shy of 9 cents in the dollar. So I want to make sure the company is making money. So what this means, net profit margin for every $1 of sales. So here's the sales figure. As sales are going up, what is this company making in terms of profit for every $1 of sales? So you can see here, 3,345,000, I believe that figures in sales. Right, so that's what that figure comes to. 8.91%, or just shy of 9 cents in the dollar. So if you've got a huge amount of sales coming through, and you're keeping around about 9 cents in the dollar, you can see this company is very profitable, and that's why your earnings are going up. All right, so net profit margin. Great. What's important here is it's making more and more money. Margin is rising. Sales are going up. Earnings are going up. And the earnings growth rate, the company's looking to grow its earnings by, is going up as well. So that makes my list. All right, let's keep going. Next one here. Fannie Mae. Now, you only need to go back to the global financial crisis for Freddie Mae and Freddie Mac and whatever have you. And these were not very popular stocks. They were basically bailed out, and there was going to be some severe consequences had they not been bailed out from memory. So, my memory does go back to the global financial crisis. And if you're thinking, I'll never touch that stock again, fair enough. But right now, I'm looking at the opportunity in front of me. This is doing what I wanted to do. It is going up. This is a vehicle from which I make money. All right, so the price is going up. Are the earnings going up? Whoa. So here the earnings were pretty much awful, just sort of flat. Came up a bit, dropped, but look what's happened recently. Boom. Big uplift here in the earnings. So, while those earnings are rocketing up, I'm interested. Right, so the earnings are doing something. Growth rate, look, the company's looking to grow its earnings by 24%. Net profit margin. Right, so the net profit margin, this company hasn't been awfully profitable. If you look at it, it's come from practically zero to 1.55 cents in the dollar. So it's actually a big uplift in the profits. Sales have been fairly sort of flat. So again, I'm looking at this one going, well, good that the margin's coming up, but sales have been pretty much flat. I don't know whether I'd necessarily want to keep this one in. It did jump out at me because of the big explosion in earnings, but you know what? Having a look at this, I want this company to be growing its sales. So for Fannie Mae, out it goes. I've got to be strict, because at the end of the day, if I'm setting myself a a high return requirement, I'm looking to double that money that I'm looking to invest, then I cannot accept to carry any stock that is not going to be absolute top 1% of the top 1%. So what you're watching here is you're watching the process of me selecting the top 1% of the top 1%. And if it falls short, out it goes. All right, so Leonardo DRS, let's have a look here. Growth rate at 18%, that's a pass. Earnings, let's just go through them one by one. Earnings, yes, very nice earnings, up they go. I like the share price. The share price is doing what I want. It's going up. All right, good. So the share price is going up. I'll just clean this up here so it's a bit easier to see. All right, sales. Yep, sales have turned a corner. You can see a big uplift in the sales. That is positive. I wasn't getting that with Freddie Mae in America. Right, if you're wondering why, if you've joined the webcast, wondering why I'm looking at American stocks, I've given plenty of presentations on Australian stocks. Today, I'm looking to perfect a group of stocks for the American market to give myself a bit more diversification. All right, so I like the fact that sales are rising and the net profit margin, yep, and so the margin continues to go up. Good. Dash. Now, I don't like the long-term picture of Dash. It's not good enough. I wouldn't say that's the top 1% of the top 1%. In fact, that profile there was very awful, to say the least. But what is interesting here, something's happening. There's a turnaround here. Net profit margin is starting to pick up. Sales are starting to grow. Growth rate is at a whopping 48%. That's what they're looking to grow their earnings by. All right, so I'm looking at this going, okay. Stacking up for now. Earnings keep going up. So does this make up the top 1% of the top 1%? Certainly not historically. Unacceptable performance here. I would have been bitterly disappointed with that stock. In fact, I wouldn't have held on to it. But I'm looking at the opportunity right now in front of me. All right, so, yep, all right, that jumps out. Deutsche Bank. Wasn't too sure on this one. So again, if you're wondering what I'm doing here, I'm trying to build up a group of stocks in America that, to me, represent the top 1% of the top 1%. Because I'm looking to effectively double my capital in the next 12 to 14 months. Right, so I've allocated 207,000 Australian dollars that'll be going to the US market. And I only want to pick the best of the best. This is my hard-earned money. I'm not going to accept second best. Right, so I'm looking at this growth rate. I don't like the fact it came off and then came back up. But having said that, the growth rate of 21%, it dipped all the way down to 3%, but it started to recover again, and this is what they're looking to grow their earnings by. So interest rates plus inflation. If interest rates are 2 to 3%, inflation's between 5 and 6%, it's more than outperforming interest rates and inflation. So you're going to see growth. Net profit margin. Looks like this is what interests me. The turnaround in the margin, 7 cents in the dollar, coming up now to 9 cents. Doesn't sound like a lot, but that's quite a big jump in percentage terms. So the key then is sales holding steady or growing? Well, sales are holding steady, they're growing. Right, so sales are picking up. Net profit margin has started to pick up. All right, and as a result, the earnings growth rate outlook is picking up as well. The price pattern is doing what I want it to do as well. It's going up. All right, so I've been very strict. I've been going through a lot of stocks, and I'm just giving you an insight. I'm going to show you now. We're going to go back to the coalface to see what else we can find. All right, so 3 so far. Let's view the watch list average. Right, so that's what I'm looking to invest. 207. I haven't pulled the trigger yet. When the time's right, I will pull the trigger and jump in. 3 across 207. There's no way. I want to, allocate. What's that? $60,000, $70,000 across 3 stocks. I need more. So the question I've got to ask so far is this sufficient? Net profit margins coming up, good. Growth rates coming up. Sales are coming up, good. There is something that, if you're more conservative, if you're looking at the valuation, there's a big differential in the valuation, 104 versus 44. It doesn't mean that that you shouldn't go ahead and do it. It just means that you better make sure that all these key metrics stay in place, because as soon as one of them starts falling away, investors that are paying a big premium for a group of stocks, they won't be so pleased to pay that premium. So this is going to rely heavily on the proviso that earnings keep going up. If these group of stocks earnings start falling away, chances are investors are going to dump those stocks very quickly to go back to meet the valuation. They won't be so happy to pay the premium anymore. All right, so this is slightly bordering on high risk. So let's see if we can make it a little bit less risky. But those three jump out so far. So back to the search. Let's go stock viewer, and I'll just change the layout here. These are the best fundamental and technical stocks money can buy for the American market. We rank, sort, and analyze them each and every day. I'll just do the top 5, information overload here. Top 5 stocks. So we rank it by this indicator VST, which finds you the best combinations of fundamentals and technicals every day. So I'm going to go through and see if I can find, let's go through the first 20 and see what else we got here. It's got to jump out. Got to get earnings, got to get everything stacking up. Right, so I'll pull that back a bit. I love the earnings on this. Share price to me is a little bit sort of all over the place. Sort of comes in waves, up and then down, up and then down. This was quite a nicely pullback, then up. Just, not good enough. It's got to be the top 1% of the top 1%. Still a great stock. I just don't like the volatility. But that's me. NVIDIA. I mean, what went on here, NVIDIA? A lot of panicking over here. It went from 140 all the way down to 97. That was pretty tumultuous. It's been an absolute blue chip stock over the years, but I haven't seen price behaving that badly for quite some time for NVIDIA. So I don't know. I'm kind of looking at it going, well, is this indicative of more of that behavior? I don't know. Certainly if you had bought in as it started turning around, you've made yourself a small fortune. All right, well, not entirely sure. I'll need to go away and think about it. Again, a lot of volatility here. Lovely performance in recent times. Look at these beautiful earnings. Up they go, but the volatility that crept in. And this was indicative across a lot of really good quality blue chip stocks. So I'm sort of looking through here going, well, textbook earnings. This was all to do with the market. A lot of panic over tariffs and whatever have you. Let's see, how much did this one fall? Doesn't look quite as big as some of the others. 212 down to 175. It's still a pretty big drop. But you can't fault this one, certainly from the earnings. CRS, beautiful earnings, growth rate hovering at 30%, 32%. Sales, up they go. Net profit margin, wow, look at that. Net profit margin keeps going up. Sales keep going up. The growth rate outlook, as you'd expect, is very, very strong. Actually, this is not a bad one. So I'm going to jot this one down. We'll put it in. CRS. Okay. Keep going. Far too much of a pullback on that one there. Wow. This one here, I mean, the earnings started to turn around here. So if you just purely looked at the earnings profile, forgot everything else, and said, wow, look at the earnings. And you put the share price on, well, the share went from 18 to 78. I don't know. I mean, you can only be the judge in terms of what you're comfortable with. It's fairly volatile prior. This one here, brilliant set of earnings. The market sell down over that time period. Seeing if I can get one that's not quite as volatile during that time period. So I'll move on. I mean, some brilliant stocks here. Let's just see. So I have another tool up my sleeve here. It's called the Comfort Index, CI. If I sort all these stocks by CI, the Comfort Index, what this will do is it'll find me some of the smoother stocks. They don't necessarily mean that they're the best fundamental stocks. So right now, you can see why it's got such a high Comfort Index score, because, well, it's hardly been around at all. It's only been around for 2 months, and it's just gone up. So let's pull it back a bit more over time. This one here. Bit of a pullback. It's shooting up again. See if we get one that really jumps out. Ooh, I like this one here. See, during that April, May time period, we didn't get that 20-30% pullback. Went from 410 to a low point of 364. Actually did occur there a little bit, but it sort of held and then it pulled up. Not quite as big a pullback. So let's drill in a bit more. Pull in the earnings here. Wow, look at the earnings. Brilliant earnings. Up they go. Your profit margin. The margin keeps going up. Sales keep going up. A little bit of a premium being paid. This one's actually not too bad. So what's this one here? ESLT. All right, I'll keep going. See what else we can find. This is not bad at all. 129 hit a low point of 115. Actually wasn't too bad, was it? Considering what had happened with many of the others. So this one has actually proven itself to be a fairly resilient stock. Here's the comfort index score, incredibly powerful. Breaks above 1, holds above 1. Many of our subscribers love looking at this one here because they just want to say, okay, it's above 1. As long as it's above 1 and earnings hold up, I'll hang on. Well, if you'd followed that methodology, it definitely went above 1 there. A couple of days it had gone above 1. Maybe you wait until the earnings pick up a bit more. So at that point there, yep, well above 1. Earnings are rising. What's the price? 43.24. I only look to get out when earnings break down and the comfort index goes below 1. It's on a scale 0 to 2. Well, it never did. And so it went from 43 to 184. All right, so there are a couple of these stocks that can really be game changers. And so here we are. I'm going to jot that one down, HWM. Let's see. Let's keep going. This is not a race. You know, I'm not looking to rush out and got to deploy my $207,000 today. No. If I don't find anything that stacks up or works for me, it might take several weeks. All right, it's got to be absolute pinpoint precision. So I've done, I've done it before. Doubled my capital on numerous occasions. This time around, I'm going with a bit more. The way I do it, it's got to be the top 1% of the top 1%. And again, please, no personal advice. I cannot advise you personally as to whether any of these stocks are suitable for you. Okay, so I just want to put that out there per the disclaimer statement right there at the start of the presentation as well. Okay, let's keep going. What else we got? And so here we go. No, definitely not. I don't like the fact that the earnings were so lackluster for so long. Okay, sure, it's just started to turn the corner, but it's been very volatile in recent times. I mean, look, if you're more aggressive, it's doing exactly what you want it to do. It's going up, and it's going up very nicely. And look at that over the February, April time period where most shares were getting punished 20, 30, 40% with all the tariff talk. This one barely lost any sleep. So again, it's going to be up to you. I just don't like the fact that there was this big period of downtime here, and that, you know, for me it's got to do better. All right, so I'll keep going a bit more. Too much pullback here, just too much. And again, you know, I want to be fussy because it's my hard-earned money. I'm not prepared to put up with the top 70% or 80%. No, it's got to be the top 99.9%. It's got to be the top 1% or the top 1%. Anything less, unacceptable. Then it simply won't be selected. And so, you know, you've got to be fussy because that's how you make money. Buying, you know, second, third place type stocks is not going to make you money. Sure, it might from time to time, but not consistently. And so it's a skill set, and so I'm showing you how I use VectorVest, and it's actually quite fun because at the end of the day, you're now in full control, not someone else. You call the shots. And so looking at this here, I don't like the fact that the earnings took a breather. You know, what was going on here? Why were the earnings breathing as such, not surging up? Let's see if I can get further evidence. Yep. The earnings were coming off because the net profit margin came under pressure. You know, so again, it's just not good enough. All right, so moving on. It's got to jump out. So what I've done here is I've sorted it by the smoothest left to right trending stocks. So brilliant from a technical perspective. You know, one of the finest ones you'll see. But from a fundamental perspective, now I want to overlay the fundamentals, that the earnings are just a little bit sort of ratty. They're just not quite good enough. Sort of falling and bouncing despite the shares surging up. Brilliant. So from a technical perspective, 10 out of 10, this is doing exactly what you want it to do. But it's just not performing from a fundamental perspective. Sales are good. Net profit margin, bit ho-hum. And the earnings are certainly, there's too many question marks on the earnings. All right, so let's go back to my watch list. For that run there, we were able to dig out 3 or 4, weren't we? All right, so here we are. Hopefully I've written them down correctly. Was it this one, CRS? We found ESLT and HWM. Were those the ones there? Let's have a look. So I've now put them in. I'm up to 6. I'm going to look at the average across those ones here. All right. So this is the net effect now. Right. It's got to jump out. It has to be perfection. This has to be the top 1% or 0.1%. Otherwise, out they go and we revert back again. Right. So, yep. Now I'm looking at what's happening now, because I'm going to look to go now, or at least in the next couple of days or whenever that might be. It has to be working now. So right now I'm looking here. Is it working? See a big uptick in the earnings again. We know that rising earnings, rising share price. Right? Sure as day. Rising earnings, rising share price. Okay. Sales. Let's have a look at the sales here. Is this good enough? Well, a little bit of lumpiness. I'm not 100% convinced on the sales profile. It's good, but it's not good enough. So again, I'm going to go and see what weakness I can find. The growth rate, there's no weakness here. That's good. Earnings growth. So this is the earnings growth rate. If you ever get stuck with any of these definitions, right-click any stock, view full stock analysis report, and in here you'll get all of the write-ups. Just print one out. Doesn't matter for what stock, because you'll have all of the definitions for you. Okay, and so if I'm looking for any of the definitions, they'll be here. Here's GRT, what I was looking at. Reflects a company's 1 to 3 year forecast and earnings growth rate in % per year. In this case here, CRS has a forecast and earnings growth rate of 32%, which VectorVest considers to be excellent. If you've got an earnings growth rate that is not good, watch out, your share price is probably going to be falling. Right? So this is non-negotiable when I'm looking at GRT. It has to, it has to have a strong GRT. It has to have a textbook earnings. Extra ones I'm throwing in, I like to make sure that I've got a good net profit margin. All right? Is this company making more and more money? In other words, for every $1 of sales, these guys are keeping just on 15 cents in the dollar as profit. All right. Well, then what are your sales doing? Well, your sales are doing this. If I'm making 15 cents in the dollar and sales keep growing up and up and up and they keep going up, well, that's good. Here, I'm making 15 cents in the dollar and then it dips slightly. Then I'm making 15 cents, the dollar picks up again. So this is why I'm viewing this as a weakness. This is too sporadic here. There's a problem here. So who's causing the issue? I'm going to drill through the individual stocks now. Let's get into it. And I'm going to just be putting all these stocks on trial in regards to their growth. So why have I got a hole in my sales? One of these stocks is causing an issue. Can't be that one, can't be that one, can't be that one, can't be that one. Aha! Deutsche Bank. What's happened here? Why the dip? Why the dip? Lumpy sales. I want the top 1% of the top 1%. So, in this particular case here, out it goes. Not good enough. All right, out it goes. So, I'm back to 5. I'll need to keep doing this process. All right, so I removed the lumpy sale issue. That's much better. Okay, here we go. Let's view the watch list average across all 5 stocks now. Let's put on the price. Yes. Is this going to have impacted the earnings? Just make sure. So you see I'm being very calculated here. You can see I've doubled my money a few times. I have, because this is how you do it. No second best. Top 1% of the top 1%. Earnings going up. Sales going up. Growth rate, good. Don't like the fact that there was a breather, but right now I'm looking at this is what I'm looking at right now. And right now, that's doing exactly what I wanted to do. Growth rate. These companies are looking to grow their earnings growth rate by a whopping 29%. So looking to grow that EPS by 29%. All right. There's going to be a bit of a premium being paid. You'll find typically those high growth, high performing stocks, investors are happy to pay a premium until they're not. And they will stop paying a premium when those stocks don't deliver. All right. So anyway, I wanted to give you a bit of a taste into building perfection. I'm going to keep working on this over the next couple of days. So maybe next week when we meet up again, I'll show you how much further I have progressed. But this is how I do it. And, and then I'll go away and I'll come back the next day and I'll review it again and I'll think about it. And then, I'll keep looking. And so I'm looking to invest 207,000. So I've called it the name 207. And so I'm thinking probably 10 stocks, around about 20,000 a pop across each stock. All right, so there are the first 5 for now. I'll keep working on it. Now, again, as always, please, no financial advice. I cannot advise you personally. I hope you've got a good insight into how I use VectorVest, the amazing tools offered by VectorVest. We'll see you same time, same place next week. Spread the word. More investors need to be doing, these techniques that I show you. Once you know these techniques, they're not hard to do. Once you know how to do them, you'll never look back. You'll never buy a company again where the earnings are falling away and the share price is falling away. You won't accept second, third, fourth place anymore. You will become a machine that seeks perfection, and it's just a matter of being shown how to find it. All right, and so it's not hard, but the problem is that a lot of investors just haven't been shown how to do it. And so anyway, hope you got a lot out of today. I'm going to wrap it up here. I'll leave you just that last list there just to have a look at. We'll see you same time, same place next week. Thanks again for coming along. Spread the word. We'll see you all same time, same place, 11 o'clock on, what's today, the 16th. So is it the 24th? Next week, we'll see you. We start at 11 o'clock sharp. All right. Thanks again. Until next time. Bye for now.